In every economic cycle, there comes a moment when the world collectively holds its breath. A moment when optimism begins to fade, and the question everyone whispers becomes unavoidable. Is the next global recession already taking shape? It's 2025, and after years of surprises, the world economy stands at a crossroads. Inflation is easing, but not gone. Growth is holding, but fragile. Markets are euphoric, yet nervous, almost too calm before the storm. Across boardrooms, trading floors, and policy circles, the same question echoes. Will 2026 mark the beginning of a new expansion or the start of a global downturn? To answer that, we need to look beyond headlines, deep into the numbers, the policy shifts, and the silent signals in the data that often whisper before they scream. Let's start with the global picture. After a turbulent half-decade, the world has learned to live with uncertainty. Supply chains are open again, inflation has cooled from double-digit chaos, and central banks are exhaling after the most aggressive tightening cycle in 40 years. But underneath that surface calm lies a tension, an uneasy balance between slowing demand and fading inflation. Global growth is still positive, roughly 2.5% to 3%. But it's uneven. The United States and India are holding up better than most. Europe is slowing. China, once the unstoppable engine of the world economy, is now wrestling with debt, deflation, and demographics. In emerging markets, the wildcards of global momentum are running out of fiscal space to absorb shocks. In short, the global economy isn't collapsing, but it's slowing into something fragile. And fragility is dangerous because it only takes one spark, a policy mistake, a credit crunch, a geopolitical shock to start a chain reaction. Let's go region by region. In the United States, the world's growth anchor, things look deceptively stable. Growth is cooling, yes, but consumers are still spending, jobs are still plentiful, and wages are rising faster than prices. On paper, that's the soft landing everyone hopes for. But underneath, warning lights are flickering. The federal deficit has exploded to levels normally seen in wartime. Debt interest now eats $1 trillion a year, more than the entire U.S. defense budget. And though the Federal Reserve has started cutting rates, the impact of past hikes hasn't fully hit yet. Corporate refinancing costs are rising. Mortgage rates remain high. And with household savings depleted, American resilience may be running on fumes. Europe tells a quieter but similar story. Growth is anemic, barely 1%. Germany, once the industrial heart of Europe, is fighting stagnation. Southern Europe is doing better, but energy prices, regulation, and tight credit weigh heavily. Inflation has fallen sharply, a small victory for the European Central Bank, yet wage pressures remain, especially in Germany and the Netherlands. Fiscal policy is tightening again as governments pull back support, and the result is a continent that feels stuck. Too weak to surge forward, too cautious to fall outright into recession. Then there's China, still vast, still powerful, but unmistakably slowing. For years, Beijing's growth model relied on property and exports. Both are now under strain. The property sector, once 30% of GDP, is on its knees. Developers are defaulting, local governments are drowning in hidden debt, and consumers are saving instead of spending. Deflation, not inflation, is the enemy here. Prices are flat, demand is soft, and confidence is brittle. The government is responding, cutting rates, relaxing home buying rules, and injecting liquidity. But the truth is, China is running out of easy fixes. Its debt burden is huge, its population is shrinking, and its old growth engines are misfiring. For the rest of the world, that means slower trade, cheaper exports, and deflationary pressure rippling across borders. Japan, surprisingly, is the quiet success story. After decades of deflation, it's finally seeing real wage growth and stable inflation above 2%. The Bank of Japan has started to lift interest rates for the first time in years, gently testing a return to normality. Growth isn't spectacular, around 1%, but it's steady, and corporate reform is unlocking long-stagnant value. Still, Japan's towering public debt looms in the background, and any sharp rise in yields could turn calm into crisis overnight. And in the United Kingdom, a story of persistence against the odds. The country avoided recession in 2024 and even led G7 growth briefly, but remains haunted by inflation and high rates. The Bank of England has kept policy tight, wary of wage price spirals. Consumers are squeezed, housing is fragile, and government finances are stretched. Growth of barely 1% may keep Britain afloat, but not thriving. It's a slow grind, one policy misstep away from contraction. Emerging markets, meanwhile, are a study in divergence. India powers ahead above 6%, driven by domestic demand and technology. Southeast Asia holds steady, Latin America struggles with debt, and parts of Africa and Eastern Europe face outright distress. For many developing countries, the pandemic, energy shock, and rising dollar have drained reserves and pushed them toward default. Half of low-income nations are now at risk of debt distress. The global safety net, IMF loans, G20 frameworks, is stretched thin. Across the entire system, debt has become the common denominator. Public, private, corporate, global debt now exceeds 230% of GDP. It's a number so large it barely feels real, but its consequences are. Higher interest rates mean higher costs for everyone, governments, households, and businesses alike. And as those costs accumulate, growth slows, confidence erodes, and fragility deepens. Now let's talk markets, the barometers of belief and fear. Stock markets have soared since 2023. The S&P 500 hit record highs, powered by tech giants and artificial intelligence optimism. Europe followed, though less enthusiastically. Emerging markets recovered, but China's malaise kept them subdued. Underneath that rally, valuations are stretched thin. In the U.S., the Shiller-Cape ratio, a measure of how expensive stocks are relative to earnings, sits near 40, a level seen only once before, the dot-com bubble. A handful of megacaps now control a third of total market value. That concentration makes the system look strong, until it suddenly isn't. Bond markets tell a different story. Yield curves remain inverted, short-term rates higher than long-term ones, a pattern that has preceded almost every recession in modern history. Credit spreads are unusually tight, suggesting complacency. Investors are acting as if defaults won't rise, even though corporate refinancing walls are coming fast in 2026. And volatility? It's deceptively calm. The VIX, the so-called fear gauge, sits near long-term averages, but we've seen how quickly that can change. It takes one bad data point, one central bank surprise, to send it spiking. So what happens next? Economists see three paths. In the base case, the world threads the needle, a softish landing. Global growth slows, inflation cools, and central banks start to ease gently. Interest rates drift lower, markets stabilize, and 2026 becomes a year of subdued but positive progress. Not exciting, not disastrous, just tolerable. That's the optimistic 50-50 scenario. In the bull case, we get something rare, a global reacceleration. Productivity from AI and technology finally delivers. China's stimulus works. The U.S. defies gravity again. Inflation falls faster than expected, giving central banks room to cut rates more aggressively. Stocks surge, bonds rally, risk appetite returns. It's the Goldilocks dream, strong growth, low inflation, everyone wins. But dreams like that rarely last. We've seen how quickly gold turns to dust when the data turns south. And then there's the bear case, the one too many are ignoring. In this world, the delayed impact of high interest rates finally hits. Consumers pull back. Corporate defaults rise. China's slowdown deepens into a credit crunch. Bond markets crack under the weight of U.S. deficits, sending yields spiking and confidence tumbling. A global recession follows, shallow perhaps, but global nonetheless. Equities fall into a bear market, credit spreads blow out, and capital flees to safety. Central banks slash rates, but the damage is done. It's not 2008, but it feels heavy, like a world catching its breath after running too far too fast. Which scenario plays out? No one knows. But probability favors caution. History rarely rewards complacency, and the ingredients for a downturn are all on the table. Tight money, heavy debt, slowing growth, and rising geopolitical tension. Consider the geopolitical wildcards. Energy markets remain vulnerable. A flare-up in the Middle East could send oil soaring. Trade wars are back. Tariffs between the U.S. and China are rising again, choking supply chains. And elections across major economies could reshape fiscal policy overnight. The global economy isn't just balancing economics. It's balancing politics, psychology, and patience. Still, it's not all doom. There are bright spots. Technological investment is booming. Labor markets, for now, are holding up. Green energy transition is creating new industries. And central banks, scarred by past mistakes, are more alert to financial cracks than they've ever been. The system may bend, but it's designed not to break easily. So as we look to 2026, what should we expect? Probably not catastrophe, but neither comfort. More like turbulence at cruising altitude. Growth may continue, but slower. Inflation may cool, but unevenly. Markets may rise, but nervously. And beneath it all, the world will still be nursing the hangover of a decade defined by cheap money, easy credit, and the illusion that expansion can last forever. The next 12 months will test that illusion. If policymakers manage to land the plane softly, the world may emerge into a new cycle of sustainable, lower inflation growth. If not, we could wake up to a world suddenly reminded that economic gravity always wins. For now, the question isn't whether a global recession is inevitable, it's whether this cycle can defy the odds one more time. History suggests it won't be easy. But then again, history has been wrong before. So we watch the numbers, the markets, and the policymakers, waiting for the signal that tips the balance. Until then, the world economy keeps walking its narrow path between inflation and deflation, boom and bust, fear and hope. Because that's what it always does. And the story of 2026 will be whether it can keep walking without falling.